Can you share your thoughts on letting put credit spreads and strangles sit with a tested side until 21 DTE, at which time you would close a roll, thinking this would let time decay work in your favor versus adjusting? You're trying not to overly adjust or be too eager to roll. Yeah. Yeah, I mean, you want to manage them at 21 DTE, just like, you know, most short options trades. So yeah, I mean, that's normally what you want to do. But as far as, do you want to just sit on them and not make any adjustments at all? For me, I don't want to adjust all the time, but sometimes you have to adjust. I would say once the position becomes in the money, you need to do something. Because once a side is in the money, so the put at that point becomes a 50 delta or a little higher than 50 delta. Your call is probably single digit delta. 6 delta or 8 delta, something you're really low. That's not enough delta on the call. Because if the stock keeps going, well, you're losing $50 a clip on the put side because it's a 50 plus delta. But you're only making $6 on a 6 delta call. So you're not offsetting the losses enough, right? You got to have more delta on that call once that put is in the money. So at least cut the deltas on the put by half. So we'll use NVIDIA here as an example. Let's say this is a strangle that started life as, you know, one standard deviation strangle, 16 deltas on each side. But now all of a sudden you wake up one day, you're in the money on the put side. This is a 54 delta put, only a 6 delta call. Well, you need to protect this put by making this call have higher deltas. So how many deltas? Well, there's no exact formula that's right, but I would say you need to cut it by at least half. I think that's a good spot to start. So if you got 54 deltas, get something that's at least 27 deltas on the call side. So in this case, I could roll to the 130 strike. That's a 27 delta call. That's where I'd go. You wanted to be more aggressive and roll it down even further, even into a straddle. You certainly could do that, but I would start with cutting those deltas in half. Don, you said, what do you think about selling puts in UVXY since the VIX is high? UVXY, I haven't played with this much. So selling puts in this, I don't know what kind of pricing you would get. Not something a lot of people do, selling puts in any of the VIX products. And you get 175 credit, but buying power reduction is just crazy high. If you want to bet on like a vol expansion, just trade the VIX index, VIX, and buy calls. And go to the 36-day cycle and just buy an at the money call. Only $232. That's the way you want to play it. And that's the monthly, 36-day. But you could do a shorter time frame, get them cheaper, with less time on them. Actually, with VIX so high, obviously you're trying to be bullish as far as you think vol's going to go even higher from here. For me, I think with vol being so high, I'd play it the inverse. Is it what's the inverse? UVXY, SVXY, the short one. Yeah, for me, I'd probably just go buy some shares of SVXY because I doubt the options are all that liquid. Yeah, if I wanted to sell a put, it's buying power reductions. Yeah, $4,000. Yeah, you can't do that because that's more than the stock costs. Right? You just go buy some shares. Actually, they want 100% of the cost on the shares too. Damn. Probably because it's an inverse ETF. There is a little bit extra risk to this kind of stuff because they can sometimes collapse all the way to zero. But still, I don't hate the idea if the buying power wasn't such a mess here. Or just buy a call. And this is if you think vol's actually going to contract, go buy a call in this one. But yeah, I mean, if you got those kinds of assumptions, yeah. UVXY, SVXY, get bullish or bearish, depending on what you want to do. Obviously, with the buying power reductions being crazy, you can't sell options and you really can't buy shares either. So just buy calls. If you're bullish, go buy calls in UVXY. If you're bearish, go buy calls in SVXY. Or again, play the VIX index itself. You can go buy calls in VIX. So it'll be interesting to see what the market does today, because this market has been a little confusing the way it acts. So a lot of times when you get these kinds of market corrections, you know, it'll eventually find a bottom. But a lot of times you can actually spot, you can tell almost to the exact minute when it finds the bottom, because a lot of times you have to shake out everybody. Like there's got to be nobody left willing to sell this market at some point. And typically what happens is you'll have a really ugly day where the market sells off hard and fast, and then it's almost like it's instantly, like we get to a point where all of a sudden things turn around, and turn around quickly in a big way. What's weird about all of this is these have been some big moves, especially yesterday's. That's the biggest move of them all. But it wasn't like we sold off those 200 points in the ES, you know, in 15 or 30 minutes, right? It really was a slow move down all day. It was just slow and orderly. It was very almost scripted, right? It's like, hey, we'll move down, you know, 10 points this 15 minutes, and then another 10 points this 15 minutes, and we just keep going down. But we haven't had that kind of violent move that really, you know, marks the bottom here. I don't know if we'll get that here. I mean, who knows? Maybe this will be a situation where we'll get a reversal, and, you know, we'll never get that really nasty day. But a lot of times, like when you think about the August 5th situation last year, you know, if you were trading that was crazy, you know, how fast we moved down 1,000 points in the NASDAQ or whatever, you know, pretty quickly. Or if you go back to the COVID crash, you know, it was quite violent there, right, for a few days. I would say actually in the last 6 months, the market does not act like it used to. I don't know if any of you guys would agree. I think obviously things changed, markets changed, a lot more people are trading now, a lot more products to trade. The way people trade now, with so many people trading options and futures, and now with the rise of 0 DTE options. And then it seems like volatility, get volatility spikes more often. It is a strange new world we're in. So let's take a look at MES. At this point, I only have 2 naked puts left in MES. Took off everything else that made sense to take off. These were so far out in time, still got 66 days, and the deltas on them, 22 deltas. And so even with the market selling off, these things started live as probably 10 deltas, maybe even a little less. So still 22 deltas. I'm going to leave them on, even if in 66 days, you know, these finish in the money. I get assigned 2 futures contracts. Well, I'll take that. 2 futures contracts is fine. I didn't want 5 futures contracts. I definitely don't want 10 of them. So, you know, I closed a lot of the other stuff. And I've got a lot of bearish positions on now. And these bearish positions, like this put debit spread that expires in 9 days, is up $86. You know, and that's just an example of something that's expiring soon that's up some money. This one here that's way out in time, 80 days. That's a butterfly spread that I guess got filled as separate legs. That's the rest of that butterfly. So yeah, I don't need to separate that out. But this is a put debit spread that's up $100, expires in 66 days. Now, I've got a lot of these downside hedges that are paying off. I've closed some of these put debit spreads and put butterflies that I've had on in MES and some other things that, you know, I've been able to collect a few $100, which, you know, offsets some of the losses. That's all it's doing. If we get another down move today of some significant size, I'll probably take off some of those. James says, DT, I got assigned on a put credit spread on Tesla, the 355, 360. Yeah, you think Tasty closed out the trade? Well, if you got assigned and you didn't have the funds for the assignment, I would imagine Tasty would just automatically exercise the call, but I don't know. I mean, you could ask them about it. But if you got assigned, do you have shares? Or are you saying you got assigned but you don't have shares, but they closed you out of a losing trade possibly? Because it's the case where you got assigned but you don't have the shares and they closed out the trade for you. They probably just, they did what you were going to need to do anyway. They just did it for you. Yeah, it looks like you have no shares. So what happens is you got early assign, and they could tell that your account could not cover the assignment, but they knew you had the call. So they just automatically early exercised your long call or long put, whatever, it was put credit spread. So they exercised your long to cover the shares. So, which is what you would have had to do manually anyway to close out. They just did it for you, and which kind of makes sense. It's really what every broker should do. A lot of brokers don't, though. They make you take the assignment and then you do something with the position the next day. But yeah, if they did that for you, that's a good thing. Because yeah, these Tesla credit spreads. I've got one that's crazy deep in the money, right? A 94 delta short put, right? So no way I'm winning on this trade, right? Somebody could exercise, this on me, early exercise it. But let's assume Tasty doesn't automatically exercise my long put. Well, I'd have 100 long shares tomorrow. I would still have my long put that was part of the put credit spread. So the next day, I just early exercise my long put to get rid of my shares, right? A lot of people do ask about the early assignment, especially when you get put shares and you didn't want the shares. Okay, if you didn't want the shares and you now have shares, you just immediately turn around and close that share position. So if it's a short put, you get long shares. If it's a short call, you get short shares. But you didn't want them, just immediately the next day on open, close the position. Because some people worry about, oh, now this has pushed my buying power from 50% to like 95%. What if I get margin called? Well, if you immediately just turn around and close that position, you don't have to worry about it. Yeah, as long as there is extrinsic value left, chances of assignment are slim. We could actually check the extrinsic value of my options. That'd be a nice little intellectual exercise. Let's go find my put credit spread. That's, a million miles away from at the money. So this short put currently trading around 109 mid price. That's crazy because the corresponding call it's trading at 181. Yeah. So yeah, there's not much value left in that put as far as the extrinsic value. Let's actually change from open interest to extrinsic. You guys probably didn't notice that there was an extrinsic column here that you could switch to. It's normally you don't need to look at it, but you can look at it. You see it's 181. I usually have open interest here, but you don't necessarily need to look at extrinsic value, because if you got some like deep in the money option like this put, all you need to do is go look at the corresponding call, because this call priced at 183. That was essentially our extrinsic value that it was reporting. So yeah, there's not much extrinsic value left in my option there. A little bit, but could an early assignment happen? Sure. Like, it wouldn't be the craziest thing to get assigned on something that's so deep in the money, because rarely do you have something go so bad against you. Like, I sold that thing as a 30 delta put probably, and now it's like a 97 delta put, right? It's crazy. But yeah, when you get something that's approaching, 100 delta, at that point, yeah, it's early assignment is very likely.